policy of a firm, that to what extent and how much dividend should be paid and how much earnings should be retained by the firm. First and foremost, age of a company. So, if the company is a young company, then it will have to retain more and distribute less, because the external sources of finance available for the company will be limited. But for a company which is, say, a mature company already functioning in the market for a long period of time, it will have access to debt as a source of finance also, and hence it can afford to distribute more earnings as dividends to the shareholders. The second factor that affects the choice of a company with respect to how liberal the dividend policy should be is the future financial requirements. This we have done in detail. अगर firm के पास investment opportunities हैं, then it should prefer retaining more and distributing less today, so that tomorrow more of capital gains can be given to the shareholders. Because if the earnings of the company increase, then the market price of the share will also increase. So, keeping these factors in mind, the firm should decide on the dividend policy. Next is the magnitude and trend of earnings. So, a company has to keep its earning history in mind when it is deciding on how much dividends should be distributed. This shouldn't be the case of a one-time dividend depending on what the earnings have been in a particular year, but you should also keep the past trend in mind. Okay, and accordingly decide how much percentage of earnings should be retained. Next is the nature of industry. Now, there are normal industries and then there are seasonal industries. So, say an industry like FMCG, which has stable demand throughout the year, can afford to distribute more dividends as compared to a company is, say, in the tourism sector, which sees seasonal demands. Then such a company which is witnessing seasonal demand should be more conservative in its approach to distribution of dividends as compared to a company like, say, a pharma or an FMCG company which is witnessing stable demand throughout the year. Then legal restrictions. So all of you know that with Companies Act 2013, there have been a number of changes in the working of companies. Now, this has been made very clear that dividends can be paid out of current or past accumulated profits, but only after providing for depreciation. Then the next factor is a desire and type of shareholders. Now, this is something which is always kept in mind by the company. What is the composition of the shareholders? Say, for example, majority of shareholders belong to the retired class. Then those people would expect some minimum dividend from the company. Again, if the shareholders, they belong to, say, the young age group, then a fluctuation on dividends is possible for the company. But with a mature shareholder group, the company will have to keep some consistent dividend ratio throughout to meet the expectations of the shareholders. Next is the taxation policy. What are the taxes on the dividend income in the hands of the shareholder, and what is the tax, dividend distribution tax, which the company needs to pay. And the last point is inflation. So all the earnings which the shareholders make, which the individuals make, should be adjusted for inflation. Okay, so if on my investment, say today, I keep my money in a savings bank account, I'm getting 6% per annum return, but the inflation itself today is above 7%. So my net return from the investment becomes negative. So inflation as a factor is always kept in mind when you are deciding the investment you want to make. First, the inflation adjusted return actually gives a clear picture, a true picture of what have you earned from the investment. So expected inflation is always kept in mind when the percentage of dividend payout is decided by the company. Okay, okay, there's one more factor which is control objectives. Control objectives again, if you distribute more dividend, then you will have to look for alternate sources of finance to fund your investment opportunities. So this is a trade-off. If you say issue more equity shares to finance your investment opportunities, then you are going for dilution of control because you are adding more shareholders, uh, adding more people who can interfere in the working of the company. So these factors need to be kept in mind when the company decides on how liberal it wants to be with respect to the dividend policy. Next topic is stable dividend policy. Now, what do we mean by a stable dividend policy? That a company keeps continuity in distribution of dividends. Now, the amount is not fixed. The percentage of earnings which should be distributed is not fixed, but what is fixed is that there will be some dividend distribution every period. Now, this can be some annual dividend distribution, quarterly, or semi-annual dividend distribution. Though generally a stable dividend policy applies to annual distribution of dividend. So, in what forms can a company have stable dividend policy? First form of stable dividend policy is constant dividend per share. So, an absolute amount is fixed for each share held by the shareholder. Absolute amount of dividend. So, say my share has a face value of 100 rupees equity share. Now, if the company fixes that every year we will be paying rupees 5 per share, then that is constant dividend per share. Now, of course, when the earnings of the company increase, the amount of dividend per share will also increase. But for a certain period of time, the company sticks to the same amount per share. So it is like preference dividend, wherein the company beforehand knows how much dividend needs to be distributed. If we present it graphically, this is how it looks like. So your earnings per share is fluctuating every year, but for a fixed period of time, you are paying the same dividend. If, say, in our case, if you have a look at this graph, after 4 years, the company is increasing the dividend per share. Then it is being maintained for another 4 years. Then, keep with respect to increased earning per share, the dividend is increasing again. So, for a particular range of time, the dividend remains the same absolute amount per share. This is constant dividend per share policy. Under the stability policy, the next policy is a constant dividend payout ratio. Now, what is a dividend payout ratio? The percentage of earnings which is distributed as dividend. So, if I have to write it in form of a ratio, DPS, sorry, dividend payout ratio is DPS upon EPS. So dividend per share upon the earning per share. This is the dividend payout ratio, paying a fixed percentage of net earnings every year. So constant DP means, say the company takes up the policy of 20% DP ratio. This means every year out of 100 rupees earned, 20 rupees will be distributed as dividend. Okay. When the earnings increase, the percentage remains the same. So a 20% ratio will remain the same throughout whatever be the earnings of the company. So how does this look graphically? This looks somewhere like this. So your DPS, dividend per share, is moving exactly in tandem with the earning per share. And the last stability policy is a mix of both. You pay some dividend per share plus extra dividend whenever the earnings are above average. So in this way, the shareholder is assured of a minimal return every year. And then, of course, if the company is performing well, the company will distribute more, hand out more to the shareholder. Okay, so these were the types of dividend policies. If I talk about advantages, then with a stable dividend policy, the biggest advantage is there's no uncertainty. An investor can plan according to the regular dividend income that he or she will be receiving. Then institutional investors, that is big financial institutions which invest in some other companies, will look for those companies whose shares are giving constant or stable dividend. Okay, and disadvantage with a stable dividend policy will be the say the company might not be able to maintain that stability in dividend. If it changes dividend after a few years, the amount of dividend or the ratio of dividend due to unforeseen circumstances, like currently अगर एक कंपनी है जो पिछले 5 या 7 सालों से कांस्टेंट डिविडेंड पे कर रही थी, but because of COVID the earnings have fallen and the company is unable to declare dividend, then the investors take it personally also, like a salary cut or dividend cut will bring about a negative perception in the mind of the shareholders. Okay, so that those expectations of the shareholders are also affected if a company switches or moves away from the stable dividend policy. So all these factors are kept in mind when the company is deciding on what type of stability it wants in the distribution of dividends. I hope this is clear to everyone. Any doubt, any question in this? So we now start with the last unit of your syllabus, which is on working capital management. So as we have covered the financial management decisions, I told you initially also at the start, there are three types of decisions: investment decisions, financing decisions, and third is your dividend decisions. So under the investment decisions related to investment in fixed assets and decisions related to investment in current assets. For fixed asset decision, we have done capital budgeting in unit 2 of your syllabus. For management of current asset investment, we'll be doing the working capital decisions. For financing, we have covered cost of capital, EBIT, EPS analysis, your leverage analysis, and your capital structure decisions. Okay, and under dividend decision, we have covered the relevance, irrelevance approaches and the factors affecting the dividend policy of a firm. So we are left with the working capital decisions or investment in current assets of a company. So management of working capital is very important. You make the best decisions related to investment in fixed assets. But if you are not having the resources to run those fixed assets, you will not be able to utilize them to their fullest potential. Okay, so working capital is the lifeblood of a business. If you're not having the funds required to maintain the day-to-day working of the business, payment of electricity bills, purchase of raw material, then these kind of expenses, payment of wages of the workers, okay, and these kind of expenses, if remaining unpaid because of shortage of funds, can stall the entire working of a firm. So for the smooth functioning of a business, sufficient amount of working capital investment is required, and hence this becomes an extremely important decision, equally important decision as the decision related to fixed assets. So, what is working capital? As I told you, the funds required for day-to-day working in the business are the main, it's basically the working capital, and the importance, as I told you, they help to maintain the fixed assets in operational position. uh, there are different estimates of how much working capital should be required. So a 34-day working capital is said to be adequate to discharge day-to-day liabilities and protect the business from unforeseen emergencies. Coming to the kinds of working capital, first is the classification on the basis of concept, and second is on the basis of need. On the basis of concept, you have the concept of gross working capital and net working capital. This we have done in accounts also. Gross working capital is just the investment in current assets, while net working capital is the difference between current assets and current liabilities. So, as a concept, gross working capital will be favorable in the sense you get to know what are the actual assets available with the firm. They help you to give you an idea about the liquidity and profitability of the business. And when you increase your current borrowings, say you're taking a loan from a bank, then it is not only increasing your liability because you need to pay back the amount to the bank, but with inflow of cash, it is also improving the current assets of the business. Second concept is that of net working capital. So this is a good concept in the sense you know what is the surplus available after discharging the current liabilities, how much funds are available to the business for day-to-day working. Then types of working capital. So you have a fixed working capital and then you have temporary working capital. So literal meaning, fixed working capital means the minimum amount that needs to be invested in working capital throughout the year without any interruption. Okay, so working capital which is required on continuous or day-to-day basis is known as fixed working capital. टेम्पररी वर्किंग कैपिटल क्या होगा? जब भी सीजनल फ्लक्चुएशन होगी इन डिमांड, Then the additional portion which is required to meet such fluctuation is your variable working capital. So if we plot it graphically, then this is how it looks like. A permanent working capital is one which is stable throughout the year, while variable working capital requirements fluctuate, which fluctuations in demand over a period of time. Okay, so this is the last topic for the day. What are the objectives of working capital management? So, there's a very important phrase under working capital management that it involves a liquidity profitability trade-off. Liquidity is the ability to meet the day-to-day expenses through adequate maintenance of cash, or how easily you are able to convert your short-term assets into cash or near cash. Profitability is earning profits. So how working capital involves this trade-off? Very simply speaking, if you are investing more in working capital, then you have less of funds for investment purpose. आपने वर्किंग कैपिटल में ज्यादा पैसा लगाया, इन्वेस्टमेंट के लिए आपके पास कम पैसा बचा, प्रॉफिटेबिलिटी ऑफ द बिजनेस विल फॉल. On the other hand, if I invest more in investment opportunities and keep less of working capital with me, that will improve the profitability, but it will lower the liquidity of the business. So a balance needs to be maintained between both the concepts so as to ensure the long-term survival of the business. So solvency of the business can be maintained only when there is a proper trade-off between liquidity and profitability. Okay. Any questions from this part?